Well, hello, everybody, and welcome to the latest edition of Investor's Guide to Thriving. Got a great guest for you tonight. We were just chatting in the pre-conference here, and I was telling Alfred that I was the first person in Canada to have both a CFA and a CMT. So Alfred joins us from BMO as a strategist, and he also has the technical and the fundamental side of things, and he's going to be talking about asset allocation today. But before I more formally introduce him, I do want to thank all our sponsors and all our partner companies that help put this event together. And of course, in particular, our educational partner and partner in the ETF world, BMO. So thanks for that. I know many of you have already started to make donations to our preferred charities. Folks, we do these events for lots of different reasons. Education is a big part of it. I'm really, been doing BNN now since the first week it was on the air in 1999, and Berman's Call was born in 2007, and now we're in the 16th season. Education is a big focus of mine, and to thank us if you learn something each week, please consider donating to cancer research at Sick Kids Hospital and dementia and Alzheimer's research at the Baycrest Hospital and Foundation. You will get an email tomorrow with a copy of the presentation and a link to repeat if you want to see it. And there'll be a link there. And if you click those links to make your donation, we will match them, all BNN viewers, up to $25,000. So it really is two very important causes, and we do it all for charity. So please encouraged for you to double up on that. And so with that, again, Alfred, you see him on screen here with me. He is one of the tenured tactical ETF guys in Canada that I would be very proud to put on the same pedestal with me. He's got tremendous experience in the ETF world when it comes to asset allocation and core and explore portfolios. And tonight, that's going to be a big part of the topic in terms of how to get that core exposure into your portfolios at a very simple, efficient, low-cost way. So Alfred, with that, I will be quiet for about 15 minutes or so, and we'll see you in a little bit, guys.
Sure, thank you, Larry. So I'll take it from here. So in tonight's presentation, what we're going to talk about is strengthening the core of your portfolio using broad market ETFs. So moving over to the first slide. So, when we talk about core ETFs, essentially what we're talking about is, think of your asset allocation mix, right? So these are essentially your basic building blocks. So think about your Canadian equities, US equities, emerging market equities, international, and also your Canadian bonds as well. So a good way of building your portfolio is building your portfolio holistically. So I think there's been a big shift when it comes to building portfolios and portfolio construction over the last 10 to 15 years. I would say prior to that, I'd say a lot of investors typically when they built a portfolio, they would typically just build a portfolio building your quote unquote 20 to 30 stock portfolio. A lot of investors would simply just buy individual Canadian stocks and then supplement that maybe with some US equities, individual holdings, and then maybe some bonds on top of that as well. I think over the last 10 to 15 years, as the innovation in ETFs has really grown and the popularity of ETFs have really taken off, a lot of investors, even do-it-yourself investors, have the ability now to build a portfolio more holistically. So similar to what institutions have done. So essentially ETFs allow investors to build a portfolio that's basically on par with a lot of sophisticated institutional investors. So with an ETF, you're essentially getting diversification. So essentially you are, through one trade, you're essentially getting all the stocks that represent, say, your US equity market. On top of that, ETFs are very tax efficient as well. So because ETFs, traditional ETFs at least, because they track an index, the turnover tends to be a lot lower compared to an actively managed fund, for example. So because of that, they tend to be more tax efficient as well. On top of that, cost efficiency, you could find an ETF that is a fraction of the cost of a traditional mutual fund. You could find an ETF that trades at a management fee of 6 basis points only. So ETFs are very cost efficient on top of that as well. But I think the broad message being here that building a proper portfolio isn't just about diversification within an asset class, but also diversification across asset classes as well. So ETFs are great tools to build a portfolio holistically. So moving forward, when it comes to ETFs and tracking an index, a lot of investors may not know that tracking an appropriate index is very important. So why I say that is because when you look at an ETF, some investors may not care what index it tracks. Our philosophy is always, to track the most institutionally recognized index. So you'll see on top of this slide the indexes that we track in terms of our equity exposures, but we also track the FTSE TMX aggregate bond universe for our broad-based fixed income product as well. So why I think the index matters is because when you look at an ETF, a lot of the institutions and a lot of financial advisors, they are benchmarked to these specific indexes. So a lot of those investors will use these ETFs because they are benchmarked to the indexes that they're going to be measured against. So because of that, you have a lot more different types of users, whether it's institutional users, financial advisors, family offices, whatever it may be. So on top of that, what that causes is a lot of different types of users. That liquidity pool is a lot more deeper, and it attracts more users, and that volume of that ETF is going to increase. And the benefit of that is the more users on that ETF, the more liquid the ETF is going to be. So you may see ETFs that doesn't necessarily have volume. That doesn't mean that it's not liquid. But with an ETF that has additional volume and is well used by the market, you're going to find a tighter bid offer spread. And if you have access to level 2 quotes, you're going to find a much deeper order book, which at the end of the day is going to be more efficient for investors to use, whether you're an institutional investor or an individual investor as well. So moving over to the next slide. This is a very important chart as well because it shows you the power of passive investing. This is basically the various categories. So asset classes from Canadian equities all the way down to Canadian fixed income. What you'll find here is that these are the range of returns from the bottom manager, so the worst performing manager, all the way to the best performing manager according to the Morningstar fund category universe. So the red dot, what that represents is our broad-based ETFs. So these track the index. So essentially this is, how does the active universe or the Morningstar universe perform relative to the index? And what you'll find is that generally the index performs well, versus the Morningstar category universe. And keep in mind the Morningstar category universe is going to include both ETFs and active managers in there as well. Another key thing to note is that for asset classes where the range of returns aren't too broad, so for Canadian fixed income as an example, if the range of returns doesn't vary that much, one thing to keep in mind is that it's going to the difference between a poor performing manager and a good performing manager is not going to be a great deal. So one thing to keep in mind there is that you may want to just minimize cost and forego active management. So moving over to the next slide. This is a very interesting chart as well. So this is a chart taken from a report called SPIVA. And SPIVA essentially stands for S&P, which is the index provider. So they put together a monthly report called again, SPIVA, which stands for the S&P Index versus Active. It's a very interesting report because it highlights how active managers perform relative to their respective index. And what you'll find here is that over the long haul, most active managers tend to underperform the index. That's not specific to any asset class, as you could find over here, whether it's US equities, international equities, or whatever asset class or whatever cap size, most active managers have a very tough time in beating the index. So the overall message being here is that if you're building a portfolio, the best way to get exposure to those specific asset classes is just perhaps just focusing on index-like returns. So moving over to the next slide. This is our core ETFs. So these are the major building blocks that we offer. So as I noted before, what we do is we track the most institutionally recognized indexes. Another benefit of our ETFs is that in addition to just providing exposure to the index, we also have different currency examples as well. So ZSP, for an example, we have ZSP.U, so that is trading in US dollars on the Canadian exchanges. And the benefit of that is that very often a lot of investors that are exposed to estate taxes that buy the US listed securities, they're going to be exposed to US estate taxes. But because a Canadian listed ETF that trades in US dollars, it essentially provides the same exposure, but because it's registered as a Canadian mutual fund trust, it's exempt from a lot of the estate taxes. So a very useful tool for those investors that are exposed to estate taxes. In addition to this, what's not listed here is we also have currency hedged options. So the best way of thinking of currency hedged options is it essentially eliminates the impact of currency. So think about if you're investing in ZUE, which is our currency hedged S&P 500 ETF, it allows investors to invest as if they are a local US investor investing in the S&P 500. So the next slide is, I think, one of the more critical or more important charts in this whole presentation. So this is something I learned early in my career. So I started my career in the pension consulting side of the business. So one thing I learned early in my career was this study, which was often highlighted in that industry. So this was in a study that was put together that basically just tracked the differences or what explained the differences of between one portfolio to another. So whether it was asset allocation, market timing, or security selection, there were a number of studies put together, but the commonality between all those studies was that asset allocation was overwhelmingly the most important decision when it came to building a portfolio. So when it came to security selection and market timing, it really paled in comparison when it came to explaining the differences in performance between one portfolio to another. So moving on, this is another chart that I think is a very powerful chart as well. So this explains the importance of diversification. So this basically just highlights all the various asset classes and how they perform in each calendar year. So what you'll notice is that various asset classes will vary from year to year. So a good way to kind of smooth out your returns and smooth out your ride over the long term is basically just getting diversification across those asset classes. As I mentioned, at the top of the presentation, whereas a lot of investors focused on diversification within an asset class, 10 to 15 years ago, now it's more important to focus across asset allocation. So ETFs, as I mentioned, are a good way to get exposure to all these different asset classes. As you can see from the gray box, which is a balanced portfolio, which basically is a mix of all these various asset classes, it usually is, the midpoint between all the various returns. So that's a good way of navigating volatility and minimizing the volatility in your overall portfolio. So moving over to the next slide. This, I think, is a very powerful chart as well. So I put this together a couple of months ago, and this basically just compares two portfolios. One portfolio which stays invested in the S&P TSX over the long haul. The second portfolio is basically a portfolio that tries to time the market. So portfolio B, all they did was they cashed out of the TSX, so remained in cash for 2 months in the market bottom in March of 2009. So during that period, just by missing 2 months, the return difference over the long haul was pretty significant. So it was almost close to 55%. So that essentially shows you the importance of staying invested over the long haul, and market timing is extremely difficult. So moving over to the next slide. When it comes to asset allocation, I think a lot of investors may not have the time or the know-how in terms of how to put together a portfolio. Fear not, because there are asset allocation ETFs that are available. So these essentially are prepackaged solutions that allow investors to basically get an asset allocation model in one easy trade. So these are essentially one-ticket solutions that are based on different risk profiles, all the way from conservative all the way to an all equity model. So with a conservative, the conservative model is essentially a 40-60 model, 40% in equities, 60% in fixed income. The balanced ETF is your prototypical 60-40 model. The growth ETF essentially is 80% equities, 20% fixed income, and your all equity obviously being 100% equities. The good thing about these is that they are made up of between 6 to 9 different ETFs, professionally managed, professionally rebalanced, and a number of different ways in which you could use it. So essentially, as I mentioned, you could use it as a one-ticket solution. You could also use it to complement your portfolio by using a core satellite strategy. So using this as the base of your portfolio, but then complementing it with sector or thematic ETFs, but also you could sprinkle individual stock picks on top of that as well. So very effective solutions.
One of the things, Alfred, that I like about these is because if you want to take less risk and versus being out of the market, you can downshift. You know, if your long-term target is an 80-20, so the ZGRO, and you're a little bit worried about the markets, you could go down one notch to a ZBAL or two notches to a ZCON. And if you're really bullish, you can go up to all equities. But again, having it managed for you and in a global way in one very, very simple trade. So they're pretty elegant solutions. And I think the cost point on these is what, 20 basis points, something like that?
20 basis points, yeah. And keep in mind, that's the only fee you pay. So the underlying fees, there's no double dipping. So all you pay is the top fee of 20 basis points.
Yeah, it's really quite compelling. This year is kind of interesting though, right? Because normally fixed income protects you. But we got to a point a year plus ago where interest rates basically all around the world were pretty darn close to zero. And bonds weren't going to give you the protection that they historically would have. Now with yields back up, that comes back into being a bit more normal again.
I think so. I think the importance maybe in a couple of years will be more of a focus on fixed income, even with yields going where they're going to go.
Yeah, well, that is the debate. And as I get into my talk tonight, I think that's one of the things that I'm going to look after. So thanks very much for being here, Alfred. And a reminder on the Friday Insights for BMO, the YouTube channel. Make sure you get there, make sure you sign up. There's a lot of good information there every week. And again, Alfred, thanks a lot for being here today and for our ongoing partnership at BMO.
Thanks, Larry. Good seeing you.
You too. Bye-bye. Okay, so as a reminder, our platform for, communications and education is moving onto YouTube. We've been migrating this slowly over the last couple of years, and on an increasing basis, we're going to move to more of a YouTube format. It allows people to watch it whenever they want. They don't exactly have to be here at a certain time on a certain night. Gives us a lot more flexibility to deliver value-added education. So make sure you subscribe to that if you haven't already. So this week on Investor's Guide to Thriving, sorry for the adjustment there. Next week I'm having back surgery. I was in a car accident many moons ago in the 1980s, and the surgeon said, later in life, Larry, you'll have some other issues. Those issues started to present themselves about a year ago, and I don't know if you can tell, but the way I'm sitting, I'm almost actually completely flat here, and I got the camera set up so it looks like I'm kind of sitting up. I mean, I'm sitting up, but anyways, not important, guys. Sometimes it's TMI. I get it. Shut up, Larry, and get on with the presentation. Okay, so this week and next week, the U.S. election. A lot of questions came into BNN and to our Investors Guide to Thriving email asking about that. So I thought this would be a great week to cover it in front of the election. And really do some exploration in terms of, does the election outcome matter? Teaser, it does, but it doesn't matter a whole lot. So we'll look at that. And then let's look at this idea of the Fed pivot and how much is that a factor? As we can tell from the FOMC meeting this week, Powell disappointed a little bit. And so it was a big factor. And then, of course, our Q&A of the week. So on BNN on Monday, I showed this graphic. It was from a presentation that I attended, a webinar that I attended last week, put on by State Street. State Street, you may know, is the largest custodian in the world, and they have a tremendous database. So what I've done here is I've copied from 538.com the latest polls as of would have been probably Wednesday night. And so what State Street had highlighted and identified, and I confirmed that the key races come down to Pennsylvania, which is currently a Republican seat where the incumbent is retiring. I think it's Pat Toomey. And then the other races that are really close that are held by Democrats. And so Pennsylvania, Georgia, Nevada, we're basically in a statistical tie within about 1%. There are other races that are closer, but really not close enough that it's going to provide a swing factor. Never say never. Anything could happen. But according to State Street and what we believe to be true, all the Republicans need to do with an equal Senate at this point, tie-breaking vote goes to the presidential candidate's vice president. Vice president is the chair of the Senate, only votes to break a tie, doesn't get a vote otherwise. Kamala Harris had several times to pass some legislation, voted to break the tie, and a few bills got passed in the last 2 years. But it looks like with almost virtual certainty that the lower house of Congress is going to swing to the GOP. The margin of victory, 5 to 10 seats in that range, and enough that they probably can't get too much done. And I think that's pretty important there. If both houses of Congress tilt towards the GOP, then the president has a veto. And so unless the Senate passes a bill with 60% supermajority, meaning they would need 10 Democratic senators to vote for it, legislation isn't going to get done. So Washington calls that gridlock. And that is often a positive catalyst to limit bad spending decisions. But on a negative side, no stimulus. Well, in the environment we're in, where we're fighting and battling inflation, I can't believe they called the last bill they passed the Inflation Recovery Act, Inflation Reduction Act, completely political BS nonsense, because it has nothing to do at all with that. But you can see where the focus was this year on these midterm elections. So let's take a little bit of a deeper dive. Let's have a look at the Pennsylvania race here between Fetterman and Dr. Oz. All may know that Dr. Oz has been backed by Trump. There's quite an interesting story here. You can click around the internet and read it all, but Fetterman, who was lieutenant governor of the state, had a stroke back in, was it March or April timeframe, and he did a debate a few weeks ago, I think now, against Oz, and it was pretty evident to me that he had some cognitive impairments. And then the question came up, is he fit for office and all that? And you hate to use that as a swing factor, but it has to be a swing factor after that debate presentation. And he produced a letter from a doctor that said he was good to go and all that stuff. But what happened in the last couple of weeks is that Dr. Oz, shot up significantly in the poll. So this was a seat that still Fetterman's ahead by 538 measurements. But the gap is closing, and now we're in a statistical tie, basically. When you look at the most recent surveys on how the pollsters, on how they sort of calculate all this stuff, they rank each survey, A for the highest quality, B, C, and so forth. And so the survey gets a better weighting, better rating, because it's more tenured, it's more robust. There's all kinds of factors that they consider. And you can go to the 538 website and look at their rankings if you so choose. But if you look at the ones that are post-debate, which is anything after a couple weeks before. So the Siena College New York Times, an A+ rated survey, post-debate, showed Fetterman 49-44. And some of the weaker structured ones, so Insider Advantage, which is a B-rated survey, was 48-45 for Oz. WIC is I guess a highly rated one, AB rating, showed them a lot closer, but Oz ahead and so forth. So you can kind of see that the trend post debate has swung a little bit more towards Oz. If you look at the Beacon Research one that was actually sponsored by Fox News with an A-rated company, showed Fetterman ahead. So the better theoretically ranked are showing post-election Fetterman ahead by enough, where the ones that are showing Oz ahead are maybe not as quality a survey. So this one's going to be really close. But if this seat goes to Fetterman, then the GOP needs to win 2 seats in both the other close races. So let's kind of have a look at those. So we now have Nevada. So Cortez Masto is the incumbent senator there. She's now slightly behind Laxalt. I don't know much about him at all. I tried to do a little bit of reading this week on, where he stands in relationship to Trump. But remember, on election night, Trump-Biden, this was a state that was kind of down to the end and could go either way kind of thing. And one of the swing states, as they call them. Well, Georgia, of course, is the other one. So this could go either way. And if you look at the recent surveys, again, factoring in quality, so the A- Emerson College, sponsored by a local TV station, and The Hill, which is a political publication, showed a significant advantage to Laxalt. Some of the lower ranked ones showed a bit closer race, and Cortez, Masto ahead in two of them by a narrow margin. But the other strong one that was done by the Trafalgar Group, again, highly ranked, was also very heavily tilted towards Laxalt. So this is probably one state that is now Democratic that swings, but it's too close to call. It looks like the momentum's heading in that direction, but who knows who shows up on election night. When we look at the Georgia Senate race, so this is Herschel Walker. We featured this graphic this week on BNN, and Walker's been accused of I guess not anything violent, but having a couple of women now apparently have abortions. And the big issue in the southern states, in particular in the U.S., is this whole Roe v. Wade shift to give more power to the states to decide legislatively if abortions are legal. And some of the candidates are running heavily on this issue. And when they survey the American people, while it's meaningful, it's like the number 5 or 6 thing they care about versus the economy, my jobs, inflation right now. Those are always things. Inflation's not really a big thing. Historically, it is now. But how the economy's doing. And so Biden's presidency ratings are about as bad as they could be. This point in the election, worse than Trump's were, I believe, or equally as bad for sure, in the broad population. So in recent weeks, Walker's caught up significantly. A few weeks ago, this looked like it was a Democratic seat. So, depending on how Pennsylvania goes, but if Pennsylvania stays red and these two seats swing, you've got control of Congress by the GOP, and the 2024 election, they want the White House back. So they're not going to put forth any legislation at all that would help the economy and make the Democrats look good. They would want to, in 2024, perhaps try politically to cut taxes or to do whatever to help the GOP candidate, whoever that might be at the time, win over whoever is going to be the Democratic candidate. And I'm pretty sure in my mind it's not going to be Joe Biden again. I'm pretty sure it's not going to be Kamala Harris, and I don't know who it would be. And if it's Bernie Sanders, they're going to lose by a landslide. So it'll be interesting to see what that 2024 election. And I think that one, on a policy basis and an economic basis, on a spending basis, is going to be more important than this one. And I think very much we're looking at gridlock for the next couple of years. Again, when we look at recent surveys and where the bias, where the tilt is, in the A+ Siena College survey, Warnock was head by a significant margin. Warnock was ahead in the Beacon, but when you look at the lower ranked surveys, Walker's ahead in them. So the most recent one, Walker was ahead by a wide margin, even though they're not top ranked type surveys and maybe somewhat biased. So, that's kind of the election spin on how the Senate might go, and pretty sure, and I didn't spend any time on graphics with Congress, the lower house, because it's almost certainly going to swing to the Republicans. Okay, so, what does this matter for markets? So this window here in particular was, not the last time we had gridlock. Obama's second term also saw Congress shift to the GOP. And, we were on the eve of a great financial crisis in markets, in heading into 2005, 6, 7, 8. That period was problematic. But this was Clinton's second term, where the lower house also had gridlock and shifted to the GOP. And this period, the average return for equities was a little over 20%, had almost nothing to do with Bill Clinton and his policies, and it had everything to do with the birth of the internet and the bubble that pushed financial markets higher, and as we all know, came unglued when the bubble burst, which had virtually nothing to do with George Bush taking over at the time. So a lot happens in markets that really the governing bodies don't influence a lot, but at other times policy matters. When governments institute smart policy and good spending and support for innovation and creating jobs, that's when things thrive. And you could argue that a Republican leadership would be better at that, but Trump's tax cuts in the midterms, in 2017 were absolutely idiotic. It was a terrible way to spend the taxpayer money at the cost of massive deficits that we're now still in. Obviously, COVID, made things worse. It wasn't Biden's doing. And again, I come from the school where politically I lean center right, center being the key, right being the fiscally conservative, but center being about not extremism, not crazy ideas on either side of the aisle, but I want good policy. And theoretically and historically, I voted different ways depending on who I thought would govern us the best at different levels of government, not being partisan. And though I am a member of the Conservative Party of Canada, not the Liberal Party of Canada, but under our current Prime Minister, could never be a member of the Liberal Party of Canada, but have voted Liberal, years ago when we had different governments and there were different priorities. So I'm not partisan, just to be clear on that, and I'm not approaching my analysis here from that side. All will know that I was a vile hater of Donald Trump in terms of who he was and what he represented. I'm not a big fan of Joe Biden for that matter. I think in general, the quality of leadership that we're seeing in places in the world where you look at Italy and who's governing Italy and you just want to pull your hair out, to the recent election in Brazil where the guy that, was president of Brazil and went to jail on corruption charges is now the president again. And oh my God, is that better or worse than Bolsonaro, who has no clue about, and the importance of the Amazon forest? And so don't get me started on criticizing politics. Anyways, sorry to deviate from that, folks, but sometimes I get passionate about this stuff. So, if we exclude this period where we had a Democratic White House and a Congress that was split, being a very strong component, this chart is less meaningful. So what it showed here in the State Street, webinar that I attended last week, was that, under a Democratic president and a split Congress, that you had the best equity market outcome. And I thought that was very, very misleading, because if you back out that one period, it's not as impressive. But the message here is more about the gridlock. When you have a Republican president and you have a Democratic Congress, the outcome was a lot worse. And that's kind of interesting. If you have a full blue wave, you get that number and so forth. So, we're not going to see the blue wave, almost certainly. Clearly, the White House is Democratic. So you would argue historically a slight bias towards a better equity market, but I think you've got to adjust for a couple of things in small sample sizes. What's more important that I thought from the State Street data is what happens to inflation and interest rates? Because as a factor of markets and in the environment we're in now, what inflation does and hence interest rates is far more important than this historical representation of what happens in the economy and earnings and markets, given the different makeup of our governance. And so with inflation running hot and hopefully coming down, what historically has happened with interest rates. And one of the reasons for perhaps this outperformance here is that in this regime, you had a lower average inflation rate and you didn't have an increase in interest rates or a meaningful increase. In a blue wave, you did, because in a blue wave, you got a tremendous amount of spending and stimulus, which it just doesn't make sense to get at this point, given the fight on inflation. So, that leads us to believe, let's have a look at this chart. And what this chart shows is the long-term multiple or the multiple on stocks based on the interest rate regime, the inflation regime we're in. And so, we've been in this 0 to 2% inflation range for a long time. And if we're going back to one where the Fed is a bit more comfortable in the 2 to 4% range, they keep talking about 2 still, that the average multiple comes down, but not by a lot. But if we get into a inflation regime that settles more in the 4 to 6% range, that the multiple on stocks comes down even more. And I think we're more in the 2 to 6% range for the next, call it, decade, as the world rebalances supply chains and just-in-time inventories become just-in-case inventories, and so the cost of making things goes up because we're losing a lot of productivity. Some of that productivity will be gained through technology, but that would be at the cost of jobs in a lot of cases. So, balancing all that, the multiple on stocks probably comes down a notch relative to what we've seen in the last, call it, 15 or 20 years. So I think when Jay Powell yesterday in the press conference said, based on last meeting, we think the terminal rate could be even higher. What he was saying, higher for longer, but what I'm saying is higher for longer. I didn't coin that. I saw it somewhere and I thought it was kind of, an emphasis on the theme. So I think we are going to see Fed policy restrictive. It's a good thing. It's a bad thing from the perspective of the voting machine when we talk about what the market wants. The market wanted the Fed to pivot. And when the initial headlines came out, it was, they're going to slow the rate down, and the markets responded. And then as Powell got up there and said, wait a minute, the markets kind of came back the other way. So, you know, Powell, a couple of quotes from Powell. So Timoros, he is the Wall Street Journal reporter that the Fed leaks stories out. So a couple of weeks ago, when they leaked that story out, it came through him, and that's when the markets turned on that Friday, if you remember. And we had talked about that last week, and I think maybe the week before. No, last week for sure, and in our weekly YouTube post. So he asked about the moderating the pace of increases, and he said it's now, they planted this question with him. He said it's now much less important about how high you're going to raise rates, but how long you're going to keep it there. And what that has done is it's taken the magnitude and made it the duration. So how long, higher for longer. And so the Fed wants to make sure the inflation genie does not stick and comes back down. And it's just going to mean more economic pain. And that means stuff for earnings, and that all of that is far more important for what the equity market does and risk premiums than the outcome of the election. And that's kind of my big message tonight. You know, he said it's very premature to be thinking about pausing, very, very premature. So when you look at what the Fed funds futures were the day before the meeting, so 2 days ago, November 1st close, that's the blue line, and to what it was pricing this morning at 7:46 a.m. when I pulled this chart off. Obviously, I couldn't pull it off too late in the day when preparing the presentation for today. And you can see that the terminal rate got kicked out a little bit at a little higher level. 95 means a terminal rate of 5%, which is kind of where it was before the Fed. And now it's pushed out to 94.80, which is 5.20. So they've added another small rate increase, and they've pushed that, you know, the idea of cutting rates now, you know, into 2024, where they were cutting rates starting in July, right? And you can see how that blue curve starts to rise, which takes your 95 and makes it, you know, close to 96, which would imply a 4% funds target. You know, so they're going to keep policy restricted 4 to 5% in the funds rate right now through 2025. And that's, again, more economic pain. Today, the Bank of England, in their update, they raised rates 75. They said more to come. It was a little bit dovish, but the reason it was dovish is their forecast was that the UK economy would be in a recession for the better part of the next 2 years. And normally, if a central bank is forecasting a recession, they're cutting interest rates and stimulating. They're not raising them and raising them more. So you have this environment where the central banks need to keep this inflation genie in the bottle. And really the path and outcome is going to be how quick and how fast does inflation come down? And if you believe David Rosenberg, it's going to fall pretty rapidly through 2023. And if you believe Mohamed El-Erian, they may not do enough to keep the inflation genie in the bottle. And so who do you believe? I don't know. My inclination is that inflation has peaked and will come down, but is not going to come down to 2, which to me is higher for longer. And so we've got far more headwinds economically in terms of restricted policy the next few years than we have tailwinds from a pivot or perspective of a pivot that can goose asset prices for a prolonged period beyond a few days or weeks of an oversold condition. And that's the environment we're in, which, folks, is a bear market. So again, getting back to what drives equity multiples, it's, equity risk premium driven by the risk-free rate, driven by long-term interest rates. And so you've got to forecast earnings. So if earnings grow rapidly, like this forecast that RBC thinks will happen, equity markets are going to do just fine in the next couple of years, as long as inflation and yields remain contained. So how much in a era of 4 to 6% interest rates, or 3 to 4%, how much can earnings grow? And the answer is they can grow. We're not stuck in a depression or recession forever. But I'll tell you, if the inflation genie gets out of the bottle, you're looking at a decade, perhaps like the 1970s, where you have this kind of economic malaise, wage demands go up, and it's not good for margins. And that is one of the factors for obviously driving earnings and the PE. So, earnings growth, that's what we get back to at the end of all this. So again, looking at our slides of the week here. So, S&P 500 on the top, updated as of yesterday's close, printed off first thing, Thursday morning. And you can see again over the last week, another little notch down there in earnings. So forward earnings expectations are coming down. And let's say, and this number is forward 12 months. Let's say this does fall another 10% and comes back down to 200 on the S&P, by the end of next year. And that would only be a very, very mild recession. And right now, that's probably the scenario. If inflation doesn't come down, they need to raise rates even more. That makes it worse. Well, that's data dependency, and that's probably not going to happen. But it's not. It's a risk that the markets right now aren't really thinking about. So 200 earnings for 2023. The multiple, if inflation comes down to 4% range, that multiple can be around 16. 3,200 on the S&P is more and more coming out to me like a downside target that at some point, in the next quarters, that will probably test. Again, interest rates, big factor. So the 30-year bond rate, I hope that we hit a peak. I hope, I'm using the word hope. The QT, the Fed said they're going to continue the 95 billion. The quarterly refunding announcement showed that they're going to need 550 billion per the next 2 quarters of funding, more than the initial expectation of around 4.25. That's the QT at work there. But they're going not to issue more bonds to do it, more longer term interest rates. They're going to do it in the bills market. So we're going to start to see some of that excess in repo get used, but not in a material way. And that's kind of the next 6 months of funding needs. Every quarter, this gets announced. I actually have a link on one of the slides here that I'll show you how you can go see that. The next announcement is around the end of January at this point. So looking at our charts of the S&P 500, again, printed off early this morning. Last week, when we looked at this chart, I talked about the 4,000 level as a distinct possibility. I think I mentioned that we hedged half our portfolio at 3,900, and that at 4,000 that would trigger a hedge on the other half, a risk reduction. I don't think we're going to see that at this point, given that Powell, Jackson Hole was his big down move here in late August. Jackson Hole the Q&A yesterday, and basically wants asset prices to remain weak, not strong. So you're not going to see a lot of rhetoric out of the Fed in the next 6 weeks before the next blackout for the mid-December meeting. You're going to see the higher for longer mantra. You're going to see the data dependence. You will see the slowing pace commentary. The markets will like that, but remember that it's not a reason to juice stocks higher at this point unless earnings are going to back it. And for earnings to grow here, you need better economic performance, and the data that's coming in, the ISMs, the retail sales, everything we're seeing is weaker economy. So that's good from the perspective of bad news is good news, and maybe the Fed won't have to raise rates in the Mohamed El-Arian scenario of too much. But, you know, we get Friday morning, tomorrow morning, we get the non-farm payrolls, again, expected to be a pretty good number. And there's some decay there, but really there isn't any at this point. The weekly claims numbers are still very, very, very low. Historically, that number needs to get up well over 300,000 a week of job losses to signify that you're in a recession, and we just haven't seen that yet. Are we going to see that? Absolutely. When is it going to come? Sorry, folks, I'm adjusting a lot because my back's, you know, giving me problems sitting. We're going to see a lot of you know, commentary on the data and pivots and pauses, and but probably be confident that we're not, you know, we haven't seen the bottom. So that test of 3,500, I think there's another leg down here to come. How it unfolds, I'm not clear on yet. You know, earnings for the most part, 60% done now. Big tech, we've heard from a lot of bad news there. I think we're going to come back down below 3,600 again before the markets can mount any kind of rally towards 3,900 again. But you know, there's not a lot in my mind here that is other than technical oversold conditions that are really positive in front of us at this point. The seasonal bounce has been mitigated, I think, by Powell's commentary. And will there be a Santa Claus rally? Yeah, that might be, though, from 3,600 back to 3,800, right? So you know, choppy markets, volatility expected to stay high, and that's kind of our latest spin on things here. I'm now kind of, you know, the odds of hitting 4,000 between now and say the end of the year, it's less than 20%. So not a high probability here. Okay, so let's get into some of the Q&A. So have markets slipped this week in response to worries around the upcoming Fed decision? So obviously this question came in the email preparation. So last week we did the lives. This week we're gonna do the email ones and kind of try to rotate weeks. Again, next week, because of my back surgery, we're gonna do a pre-tape quite early in the week, actually. And so there'll still be a lot of good content there. I think we'll have seen the U.S. election results at that point. So some more commentary next week after that. But the quarterly refunding, again, if you did a Google search on this, but when you get this document, you can click on this link. It takes you to the report that comes out afterwards. Many of you, through your online resources, aren't going to have access to this type of data, but it's going to be very, very meaningful through this QT period on how the Fed attempts to unwind their balance sheet and how they fund the deficits going forward. Because, make no mistake, we're looking at trillion-dollar deficits. We're looking at QT unwind. So they've got to find a couple $1 trillion. There is excess cash sitting in the repo market with that magnitude on it. And I've talked to a lot of people who have a lot of insight into treasury and refunding and financing and the money supply and the impact on capital markets in the last few years. And the best information I'm getting now is that Janet Yellen wants to use that, if possible, to stimulate markets in the economy closer to the 2024 election. And again, this is why I say I'm center right and not partisan per se, because wow, wow, not doing something that could help for a political reason. To me, you want to, you want to do that. And I get Trump was saying, hey, I'm going to be the guy to clean the swamp. You got to know he is the swamp. Anyways, I know I get hate mail when I dump on him, but I think I dump equally on both sides when I'm not a fan of policy. But try to understand what the impact of QT means from a funding perspective. It's pretty important because if more dollars needs to go into the bond market, less money to go into the stock market. It's that simple. Or at what cost of money? So interest rates need to go up. Interest rates go up. What happens? Equity risk premiums go up. Stock market goes down. It's all tied in together. And again, far more important than who wins the election. The good news from the election and gridlock is we're not going to get more spending bills, and hence that extra element of the Democrats spending stupidly, perhaps, and trying to get more things into this, Green New Deal and more extreme part of the Democratic agenda. It's not coming. They couldn't do it when they controlled everything. It's not going to happen. They got in what they could. Can I explain why Russia and Ukraine are exchanging goods like grain if they are at war with each other? Why is Russia helping them? So I'm not sure exactly where this question came from, but commerce still gets done in times of war. It's obviously a lot more difficult. Russia agreed to let Ukraine ship wheat to parts of the world that were starving. Humanitarian considerations. So the world still works that way. Soldiers need to get fed, food channels, food lines need to be open. Russia sells their products and they need revenue to fight the war. There's all kinds of reasons. I mean, if it was as simple as let's shut down the world, cut the borders off, cut Russia off at their knees. They're not a country that's self-sufficient. They don't make everything they need. They actually need to import a lot of things. There's a lot of Russia that's not farmable. Most of the agricultural comes from Ukraine. Part of the reason Russia wants the Ukraine back into the union, so to speak. Anyways, geopolitics are a challenge, but those to me would be some of the reasons why you're still seeing that. They're more humanitarian than anything else. I get that he's killing civilians, that is unconscionable, but starving them with food is a whole different thing. Chemical warfare, nuclear, whole different levels. So anyways, that's some commentary there. I'm not sure that really there's any market commentary that can come out of that. So here's an interesting question. Will Ottawa be calling a recession in the coming weeks? I have seen mixed reviews in the media. Trudeau is being urged to hold the line on spending. Maybe is Trudeau being urged? I guess he's being urged certainly by Pierre Poilievre. So the Bank of England hike rates to the highest rate in decades. And they said very challenging outlook. Here's the Reuters story. Again, click the link or Google it yourself. You could look at some of the story there. And really the message there, and for the first time, I don't recall ever seeing a central bank forecasting a recession and still in the same sentence, paragraph, and we're going to keep raising rates. Like, this is such an unusual period, which is largely unprecedented. And what the central banks learned from the 70s experiment was that if they stimulate now, inflation gets out of control and they have a more difficult problem down the road, and they're not going to go there. More economic pain, higher for longer. So, Ottawa, if you're talking about the government doesn't forecast or call a recession. They're in the U.S., the National Association of Business Economists formally called the recession, and they go back once the data has been in the books, and they identify, yep, the recession started then. You're not going to see Ottawa do a real-time call and say we're in a recession. It was extremely unusual for the Bank of England to do what they did today. The Bank of Canada, in their commentary, and if you're talking about Ottawa, a recession, and you're meaning the Bank of Canada, but it wasn't clear in your question. So you're not going to see Trudeau say, "Hey, we're in a recession," right? You will see Pierre Poilievre say Trudeau's going to push us into a recession. The central bank, I'm going to fire them. Like, he can't really do any of those things. But anyways, so you're not going to see Ottawa call a recession. The recession is in the data. The data is evident. What you will see is economists, more independent thinking ones than the bank economists, will say, "Hey, we're forecasting a recession." But there's a bias, just not to do that. And so you really have to get more of an independent forecast. And again, you're not going to see that from the government. You don't understand why Bitcoin mining, don't understand what Bitcoin mining is and how it impacts the environment. If the currency is digital, what is it mining exactly, and what? So the creation of Bitcoin is done by the verification of a transaction that is done by a complex algorithmic calculation. And at the end of the day, the more Bitcoin grows, the more that blockchain grows, the more complex the calculation is, the more energy it takes to do that calculation. And there was a point several years ago where doing that calculation, the energy cost exceeded the Bitcoin you would earn for verifying that transaction, the mining, if you will. And that's really, where the, well, hey, you got all this independence, digital, blah, 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 but the amount of energy it's taking to create this digital currency to verify the transactions is causing, greenhouse gas emissions to increase because of the use of energy. And so what a lot of these Bitcoin mining things did was they went to places like Iceland and the north in Russia and even, places in northern Canada where on average it's colder. And so the cost of cooling your processors that are crunching all these numbers, oddly enough, goes down. So it's an interesting question. But that's my understanding of it. And there was some pushback from the call them con artists because they're not con artists, but the people who believe in Bitcoin. I've said many times it's a speculative asset at best. I actually did tweet this week based on what Gary Gensler, who runs the Securities and Exchange Commission, congratulated Bitcoin on the 14th or 15th anniversary of Satoshi Nakamoto's white paper, blah, 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 blah. And let's make sure it's regulated. That was kind of his tweet. And I retweeted that and said, crypto's here to stay. Charles Ponzi would be proud. But as Jesse Livermore, who's known as the speculator of the 1920s era, if you've read Reminiscence of a Stock Operator, Jesse Livermore, had always says that, people are doomed to repeat their behaviors. And so, the speculative juice is alive and well. And so these things can be traded, but, not to be invested and so forth. And that's, again, my spin on Bitcoin and such. Okay, so next question here. What will happen to Shopify and why has the stock dropped so dramatically? So let me bring up a chart here and let's see if we can have a look. So actually we did a trade today in AT&T. So the AT&T was a name that we've liked for a long time on the dividend and it's on a buy dips. I've been into this stock several times over the last few years. It's weak, we accumulate, it has a rally, we sell it. It's weak, we accumulate, it has a rally. I've been in and out of the stock several times in the last couple of years since we launched stock portfolios. We added to our position, into weakness here. Earnings came out recently, had a big pop in the stock. So, recognizing some resistance up around the 200, what we actually did today was sell the stock and then sell a put to buy it back, down here. Again, this is a stock I want to own, but I just changed the risk parameter and I guaranteed myself between now and the December option expiry at least 70 cents. And so 70 cents on an $18 stock over a month and a half is actually pretty good yield. And if it dips below 18, I'm going to buy it. If it goes higher, I don't participate, but I'm going to make 70 cents in that month and a half, no matter what. So I love those kind of strategies to play stocks. Shopify is one of those, names where when you look at their earnings, so this is one of those high flying, high multiple, not profitable stocks that, Wall Street loves, Bay Street loves a growth story. Everybody loves a growth story. So, going back a number of years, stock rallies, hits its price target, analysts raise the price target, earnings come, good news, pump, pump, pump. In an environment, generally speaking, that's very favorable, with the tailwinds. Then we hit COVID, the world turned online, everything tech ripped higher, Fed's throwing money at it, stocks ripping, analysts upgrade, keep going. Now, we hit this point here earlier this year, the Fed starts taking the punch bowl away. All of a sudden we start to get misses on earnings and analysts follow the stock all the way down. It never gets to their price targets. The news keeps getting worse and worse. So when is this going to end is the question. And the answer is, I don't know, but I don't think we're there yet. Having said that, I've used Cathie Wood's ARK ETF as a proxy for innovation You know, and I love long-term, love it, love it, love it. You know, disruption, love it all. A year ago, I hated it. I hated Shopify, but I hated Shopify 2 years ago too, and missed a lot of the upside. And that's because, as I've always said, I'm kind of a value tilt to me and growth at a reasonable price. And it was a stock that, again, could be traded, but was never ever worth what it was trading at. And the proof of that is what's happened to it in the collapse. So is the bottom in? Well, the evidence is that a base is forming. You know, the low when markets were at their worst a month ago, we blow this up a little bit, you know, got down into the 30 range. We've bounced here. I think we're going to come back down into that range. You know, next time it gets oversold. So I would be interested in accumulating the stock into weakness, you know, and call it 25 and lower. How low is it going to go? I have no idea, because you have to be able to forecast exactly the business cycle and the bottom of this whole thing we're in. And it could be 6 months, it could be 2 years, it could be higher for longer. But it's a stock you can trade when it gets oversold. Absolutely. It's probably a good name. It's probably not yet time to think about a buy and hold. If your horizon is 5 to 10 years, then yeah, I think you can buy it. Don't look at it. And 5 to 10 years from now, it's probably going to be a lot higher than it is today. But you know, so will it come back? And the answer is, if you look at the tech bubble, and that's what this is, you know, and you look, so you can't look at the tech bubble for this name. But if you make the call that Shopify is eBay, or it's not Amazon, but if you know, if you look at Amazon, and we go back 1997, 2003, you know, and you look at Amazon and the bubble, and did it come back? Well, adjusted for splits and everything else, you know, it was 5 and change going down to, you know, literally pennies. So, you know, all we'll know in percentage terms, Amazon fell, I think it was 93% from the peak. So this is where we're at with Shopify, this kind of phase, and maybe in the life cycle of it. And so when does that next growth phase come? And if inflation is sticky, it's going to be a while before that, you know, comes. And so how long does it take? Well, for Amazon to get back to those .com peaks, let's have a look. So it got not quite back to those levels just prior to the financial crisis. Okay. Let's then go 2007 to today. Now, obviously, it broke out. It first got above, let me change the grid here and look at a log chart. Makes it easier when you have these exponential moves. It'll take a second for this to come through. So financial crisis, when did it get above, call it $6? You know, it was, you know, November 2009. And really lots of big volatility, big moves up and down as Amazon, you know. So where does Amazon go I think you have to think about the COVID lows, you know, as a target. You got to think about the tightening in 2018 as a target. 65 for Amazon. You don't have the same history with Shopify, but you can kind of, so that's kind of what you have to do to figure out. I'm looking at in US dollar terms. It really doesn't matter here, but so if you look at, you know, where can this bottom out to, you know, where was it, you know, pre-split here, post-split, $12. So, you know, from 33, you could still see this thing fall pretty significantly, and it would get back to the valuation it had in 2018. You know, let me do this and just have a look at some of the earnings forecast and consensus. So they're finally expected to make some money in 2023, but you know, but not much. You know, revenue growth and so forth. So that's the kind of thing you got to look for. And if these guys really aren't going to be profitable, yeah, you could see this thing come down another significant notch if we're still in a prolonged period where high growth assets, you know, need a strong underlying liquidity flow to boost them. And it just could take a while still. So, you know, very, very good question. You know, kind of tough answer. Last question here. We're getting close to the end. So when is it time to buy office REITs? So I was looking at some charts this week. So VNO, Coronado Realty Trust, or Boston Properties. These are two big office REITs in the U.S. VNO is New York centric. Boston Property is a bit broader, but also, you know, a big. So when you look at where these VNO was, you know, post COVID, $28. It's currently below the COVID lows. You go back and where this thing's trading relative to the great financial crisis, you know, there's some compelling value now in office. And the question you have to ask yourself is, are we going back to office? And I believe we're going to be in a permanent hybrid mode. I believe valuations in office will come back in many places, but not, you know, not back to pre-COVID levels. I think there's been an impairment there, and it could last a while. And we've got a new world, a new regime, new environment. But office REITs to me look really compelling from this perspective. So, you know, it's interesting here. You know, is there another bottom? Is there more to come? You know, is it worth nibbling on for the yield seekers out there? I think it is. Anyways, folks, my back is killing me, and I really have to stand up and walk around. So we're going to cut it a couple minutes short this week. And just let me, again, if you want to visit one of our sponsors, our partners, go check out their websites. There's lots there for everyone in terms of help with your portfolios. And please, if you enjoy these webinars and you get something out of them and you get an idea and you get a thought on how to make a better investment decision, you know, support Dimension Alzheimer's research at the Baycrest Hospital and Foundation. They do some of the best groundbreaking work You actually may have seen some commercials across national TV in Canada. Awareness about the great work they're doing around deferring and delaying and ultimately cure for dementia and Alzheimer's is so important. And again, cancer in children, it's sick kids. It's heart-wrenching. There's so many good charities, folks. These are two that are really near and dear to us. Please make a donation. We'll be thrilled to match them. And thank you very much, and we'll see you in a couple weeks.